Welcome to Beat the Markets.
I'm Ricker.
And I'm VKM. So Ricker, a couple of months ago, I said to you, I think we know some things. It'd be good if we could communicate that to the world. And then you went into your laboratory and came out with something really great. So you want to tell the viewers what you came out with?
Sure, we call it the Value and Momentum Monitor. It's a monthly newsletter for free. Just go to my personal blog and download a copy. It surveys all of the world's major equity markets, a handful of big commodity markets, the bond market, and REITs, for how expensive each of them is and what its momentum is, positive or negative. That's it, because we believe that that's all that matters. You can find all the information you need to manage a portfolio in valuation and price direction.
So when I brought it up a couple months ago, I was just hoping we could give people some useful information, but you've actually come up with something I think far surpassed my expectations, which is that I don't want to be too grandiose, but you don't really need anything else. You could just take that information alone and manage a portfolio and do quite well in the markets. And that's some of the things I want to talk about in this episode, because we've both been around for a while and we both have, I think, pretty well thought out ideas. And well, at least even for me, some of the information from that newsletter was pretty eye-opening. And I can talk about what I thought was kind of eye-opening. I don't know if you, from doing the work, found anything unbelievable.
I knew value and momentum worked. I'd never really seen them fail, but to put together this newsletter, I pulled over 30 years of data, starting in 1981 for most of these markets. Some of them, all the equity markets started in 81, some of the commodity markets. I went back a bit further, bonds, I think I started in 1920. So I pulled all this long-term return data, monthly return data, and I then applied the most basic rules I could to create just simple, stupid simple trading systems. One for value and the other for momentum. They're separate, they're not combined. And I applied the same rules to every market. Commodities have so every equity market has, every equity market and all the commodity markets and REITs have the same rules for momentum. For value, every equity market uses CAPE, the Shiller PE. And for value, I had to come up with a real simple method for commodities. Totally self-explanatory, nothing fancy. And I was amazed at how well these things worked in every single market. They didn't always beat the market on an absolute basis. Sometimes buying and holding will usually outperform value over a real long term, but not on a risk-adjusted basis. So each of these dead simple systems produced, they really convinced me. This is overwhelming evidence that you can reduce your risk in the market using valuation and momentum.
Well, not to get too sidetracked, but the momentum models beat the index in everything. I don't think there was one market where the momentum model didn't beat.
I'd have to go back and look at it, but the momentum pretty much always beat the market. The model is so simple. If the market, whether it's corn or silver or REITs, Sweden, Japan, Hong Kong, the United States, when a market was above its 12-month simple moving average based on the last 12 months of monthly closes, when it's above that 12-month SMA, you're long the market. When it's below that 12-month SMA, that month, you look and you make your trade at the very end of the month, the monthly close. That month, you're in U.S. 10-year treasuries. That's it. That model trades pretty infrequently. I mean, when the market is in an uptrend, it can stay in that uptrend for several months, even years. So trading costs are not an issue. This is a realistic strategy. There are no hidden what ifs in here. The only hidden what ifs would be your commissions are going to be almost nothing. Even back in the 80s when commissions are high, you're trading so infrequently that it's not a factor. They'd be your ETF fees. I mean, what does it cost you these days to buy a Sweden ETF and hold it for a year? Not much.
Right, it's minimal.
Not much. So momentum is incredible.
So, like you said, the two models you came up with, the value model and the momentum model, are dead simple models, and yet they're so effective. And that's one of my concerns for readers, is that the simplicity belies the sophistication.
Yeah.
It actually is a model that people can really use, even though it's so simple.
I mean, that's the idea. This is a key thing. The simpler something is, the more widely applicable and more reliable it is. I mean, if something has worked on all 18 equity markets that I tried it on, I've tried it on more than that. There are others that I didn't even include, like the NASDAQ. Works great on the NASDAQ. I only use the S&P in our newsletter. If something like that has worked on all these markets over all these different market environments, from the high inflation early 80s through the 90s boom, the bear markets of the 2000s, and the bull markets we've had lately. If it's worked on all these markets for 30, almost 40 years now, it's very likely to continue to work.
Okay, so this is the great epiphany, which you probably already appreciated, but it didn't hit me square in the face until I saw the newsletter, which is that, okay, so, well, let me take one step back. So I had a friend who looked at the newsletter and he asked me this after reading the newsletter, which is that I miss selling. So we released the newsletter April 1st or April 2nd, something like that. And he said, I was gonna sell my 401k, 100% of my 401k a few weeks back, so I missed it. What should I do now? And what I realized is that most of the world, or most people, are caught up in the outsmarting and outmaneuvering the markets, and what you realize is that in reality, your return doesn't matter actually if you miss the market by a few weeks or if you miss it by a few months. What really matters is your compounded annual growth rate, which is really dependent on your series of annual returns. But as important as that is, there's something even more important than your series of annualized returns for total end result, and that's time.
Yeah.
There is markets that, because we didn't have the data that you started covering in 2000 or 96, and then there's markets that you cover in 82.
I had, for price, I have price data on all these going all the way back, but for valuation we use the Shiller PE, and there's nothing special about the Shiller PE. We could have used the price to sales ratio or price to book or market cap to GDP. All of these are basically equivalent. Some are a little better than others. My margin adjusted Shiller PE, margin adjusted, cyclically adjusted PE, MAD CAPE, that one's really good. It has a very, very high correlation with future returns, but CAPE is good enough, and importantly, it's widely available. Robert Shiller has been publishing the data through Barclays, so you can just go online and download CAPE download the history of CAPE for all these different markets around the world. So that's the data I had, and that's the data I used, and the studies show that it is more than adequate.
So as a consequence of the data, we had different start dates for different asset classes.
So the CAPE data for Germany and the US will go all the way back to 1981, but for China, say, it doesn't start until the 1990s or maybe the very early 2000s.
So when you see the consequence of those 10 years, the end result is enormous in terms of the total money that's made.
Sure.
And so the important point of that is you don't actually need to find the best strategy in the world. You just have to find stuff that's good enough.
Find one that you can actually stick to, that you can live with, and then just do it.
And do it. It's good enough. Even the best strategy in the world for a few years doesn't beat an average okay strategy for 30 years.
Yeah, you're right. You're right. Another big point, I was just thinking about this today, is people might not keep as much of their money in the markets as they would if they had a strategy that offered them more peace of mind.
Absolutely.
A savings account is barely giving you anything, even today after the rise in interest rates. Residential real estate is, unless you're doing it right and buying cheap properties and managing them, it's not a very good return. I mean, the market will give you the very best long-term return in a liquid account. You can take it out anytime, buy a house with it if you want, and pay a tiny little commission for millions of dollars. So if you're afraid that you might lose 60% of your money over the course of a couple of years, and you don't know when that's going to happen because you're just buying and holding the S&P, you might only keep $1 million of your $2 million there and keep another $1 million in the bank doing nothing for you. And in that case, you're not going to compound at the 9% that the S&P will over a 40-year period. You're going to compound at 4.5%, and that's a big difference. So if you can do something that instead, forget beating the market. Momentum does beat the market with less downside. But if you just do the value model, which, depending on the run, may keep up, it may beat it. A lot of times it underperforms, but it always gives you less volatility, always gives you less downside, because those 60% drawdowns in stocks always start from high valuations. And the value model is just a systematic way of making sure that you don't own too much of an expensive market. And so, if you can live with a model, the value model might draw down, call it 35% in a worst case scenario. If you can live with that, then maybe you keep a lot more of your money in your portfolio, and you're going to end up with a lot more at the end of 30 years.
It's a really important point. I hope people appreciate it because it's the total opposite of the way the average person approaches a portfolio or they're managing their wealth. Number one, most people spend more time picking out which microwave or fridge or television set they're going to get than figuring out how to do a little bit better in their personal finances.
They're reactive. The market, and then the market, they only pay attention to it when things happen, when they read things, it seems.
And I'm all for not being foolhardy, and you don't have to have all your money in the markets when you don't know, but the point is that we use cash, like, what are the, God, there's a saying like, God is the sum total of what we don't know. And it's like cash is the sum total of the risks that we don't know. Yeah. And we intuitively may have a feeling that because based on 2000 tech crash and then the 2008 financial crisis, that there's a crisis around the corner and therefore we should have a higher cash balance. But there's a drag on the overall return for that, and you're paying a price for that, what you don't know. So you're better off getting the information, and if you want to carry a cash balance or for whatever reason, but it's better to do it out of knowledge instead of a feeling.
Exactly. What I try to impart to people is that there are things that you can know about a market. you can know how expensive it is. And valuation is information about future returns. No, the PE of the market doesn't tell you anything about what it's going to do this year, but it tells you a lot about what it's going to do over the next 10 years. And it tells you a lot about what the risks are of a major bear market. This is known. It's trivial to prove this. You can just think about it to yourself. If you're buying at 30 times or 15 times, and the cheapest the market's ever been is 8 times earnings, which is riskier. One can fall, by 70%, and the other can fall by half. So, a more expensive market's riskier. In that worst case scenario, it's just we know these things. The market is not. It is chaotic. You can't predict it really, but you can very strongly handicap it if you use the right tool for the right time frame. So another thing that I wanted to do in this newsletter is not just give you the information, but show you how to use it. All right, that's great. We give you CAPE for all these different markets. We give you a way to know whether or not gold is expensive or cheap, or oil is expensive or cheap. That's great, but what do you do with that? There's so much information out there, very little of it is actionable. Okay, momentum information is actionable, valuation information is actionable, but you gotta get away from one-off decisions, from like having this hodgepodge of stuff in your portfolio and reading something in the paper, this article or this blog post makes a compelling case that Japan is cheap. It's not, by the way, right now. But just say you read that, and then you feel like you ought to buy some Japan. All right, well, how much do you buy? And when do you sell? And what about the rest of your portfolio? You got to have a process, and it's got to be so simple that you can explain it to you. You can understand it fully, and trust in it. Understand what it's doing, what it's going through when it's having a bad time, because they all have bad times. So I wanted to show how each of these things could be used for each market on its own, in case somebody is more of a do-it-yourselfer, a trader, and they wanted to build their own portfolio that has a little bit of Sweden and a little bit of Hong Kong and Japan or whatever. But then we have these model portfolios too, which are designed to be easy to implement and are perfectly good ways to use value and momentum.
So I want to just spend a few seconds on what I thought was really awesome about the newsletter, and then I want to get back into how people can use the information themselves. Mm-hmm. What I really thought was awesome was that we know there's a big world out there. We know there's a lot of investment choices, but you don't have a framework to approach all these things, and it gives you a workable framework. So now I know if Netherlands is an opportunity, or if Mexico is an opportunity, and it makes it more realistic to be able to organize this big world and attack. It's not the right word I'm looking for, but harness it. Harness this big world of opportunity.
Yeah. For one thing, it was a winnowing down process, right? So we have 18 stock markets in there. There are a lot more than 18 markets in the world. I could have used Japan small caps or UK tech or whatever. And I had to decide, okay, Poland was out, Spain was in. But 18 across the Americas, Europe, and Asia, that gives you a good spread. I mean, that net is wide enough.
And there's something to be said for good enough.
Yeah.
There's a saying which I like a lot, which is that people don't want to buy any old thing. They want to buy the best thing.
Yeah.
But the weird thing about investing, which is so counterintuitive, is a good enough thing is good enough if it's better than anything else you have.
Yeah.
You don't have to have the very best Buffett times George Soros times some other great newfangled thing that may or may not work.
Exactly. Just pick something good that suits your style, and then just do it. I mean, time is your friend.
And getting back to the point of that you wanted to make something usable, I think it's really important people figure out how to make it usable as they approach retirement, because this story you painted of how you think people may invest, which is that, you know, they read the paper and they're like, oh, this Japan looks interesting or cheap, or this guy is interested in Mexico, maybe I should get a piece of that. And that's how a lot of people approach the markets, and they maybe can get away with it because they have income.
Yeah.
And so when you have that monthly paycheck, you know, some goes to junior school and some goes to your golf lessons or the club or whatever, however it goes. And some goes to these investments, but you don't really doing it in a very sophisticated way.
Yeah.
And it's a hodgepodge of
what somebody who likes the the thrill, the experience, the challenge of the markets, what somebody like that could do with this newsletter is to use our signals. Like, if you feel bearish, if you feel a recession coming and you want to go short something, all right, you got to decide. I advise against shorting, just as on principle, because it's the hardest thing to do in the markets. But if you're that guy, then, well, short one of the markets that's expensive and in a downtrend, because then the odds are in your favor. So scan for those, you know, the red box in the upper right-hand corner. It's both expensive and in a downtrend. Well, that's your most dangerous condition. You know, an expensive market can fall further, and a market in a downtrend is more likely to go down, to keep going down in the near term. So, you know, or maybe you're a bull or you're a value guy. Well, you can don't come up with don't like buy some thesis that you read in a magazine about how, you know, the economy is setting up to be great in Hong Kong, therefore stocks are a buy. Well, if you then check out Hong Kong, and if you see Hong Kong's trading at a Shiller PE of 25, then that's not a value play. I mean, that's a pretty rich market. But then maybe you see that something else has got a PE of 15. Well, that might be value. Maybe, like, what's the story there? Why is Spain cheap? Why is the UK? It's actually pretty cheap this year. Why is the UK cheap? Maybe look, if you're a story guy, you need a narrative. You don't feel comfortable with the numbers alone. Well, then make up a narrative. Find the story. Find the narrative behind the numbers.
Yeah, use it to do your own research.
Yeah.
But you know, to the point of that. A sophisticated money manager or a person who fancies himself a trader can use it. They certainly can, but what I would say is the number bears out that most people, 99.9% of the people should get away from that.
They should, absolutely.
And you know, we can have all the theses in the world, and we look at it with hindsight, and you know, what's the best performing market in the last 21 years? It's not, you know, you think it's one of these emerging markets. It's like France and Sweden. Like, yeah. Who knew? And that's what the benefit of hindsight.
Yeah. So check out the model portfolios.
And then getting to that point of people beginning to start implementing some sort of process. Is the process is all geared around outguessing and outsmarting and being slicker as a trader or being a genius as an investor. But what we find is the process is what's
the
really
process
important.
Trumps all of that. Process trumps insight. A good macro trader, portfolio manager is all about process. He may go on Bloomberg and talk about interest rates and the balance of trade and whatnot, themes, narratives. But what he's actually doing, if he's good, if he has a great track record, what he's really doing is something like this. He's looking at the numbers. He knows how much of his portfolio to put in. He knows when he's going to get in, what signal. He knows what signal to get out on. And it's not what he's saying on TV. I guarantee it.
And it's not that he's being deceptive, but he understands people want stories.
Yeah.
And that's what resonates with people, and that's the marketing side.
Exactly.
And if he's doing that on the investment side, then you should probably be a little concerned. But and sometimes they don't. There's sometimes people who don't really know what they're doing. They have that rigorous method on the risk management side.
It's the risk management that takes care of them. Like this futures trader Andreas Klenau proved that you could take random entries, but if you had good risk management, you would still make money. You buy things at random, but you buy the right amount according to a formula, and you sell according to wait until it goes down to sell, and then just sell. That makes money.
So I think we did a pretty good job of covering the newsletter and some things that at least I thought that was pretty amazing about the newsletter. Is there anything that you would like to highlight that we didn't touch upon?
No, I'm glad it came. I'm really happy with the way it turned out. It was a lot of work. There's a huge amount of data in here, but it's going to be an ongoing process. Every month, I update the valuation, momentum, and price data in the database, and spit out new signals and new charts. It's as much for me as as for everybody else, because it gives me it narrows down my worldview. It gets rid of all the noise. It lets me ignore the things that I can ignore, and
that's a big part of investing in trading, or being good at anything, is knowing the things that matter and how many things that don't. But it takes time to I think come around to understanding this. I mean, we both look at this and say, I wish we knew about this 20 years ago and implemented it.
Yeah, tell me about it.
but you don't know until you.
No, there's a lot of our own knowledge and experience distilled down into this letter. It's deceptively simple.
And that's the not to keep hitting the point with the a hammer or whatever the saying is, but simplicity is the ultimate sophistication. And I encourage people to reach out to us, get the newsletter, and read it. And even if they don't understand it right away, one of the things I feel has been really good in my learning process. Sometimes there's a lot of stuff I've learned that was initially started way over my head, but every day or every month I read the same thing, and over time I understand different aspects of it. Now, somebody smarter than me would have understood it in 3 weeks, and it takes me 10 years, but I still get it by doing it. So if somebody doesn't understand all the vocabulary or the jargon, which we try not to do, or they can take it and then do word searching to figure out, because there's a lot of back knowledge that requires for somebody to be able to understand it. But you can do it, and if you sit down and read it, you can really learn a lot. Now, the concern I was saying before the cameras, the concern is, and it goes back to people's human nature. What Richard Dennis, who's one of these great traders, said is, I could put my rules on the front page of the Wall Street Journal and nobody would follow it. And that's what most of the people are going to do. But I hope there's a few people out there that take us at our word and improve their lives from it.
Yeah, absolutely. There are people out there. We know many of you who understand this approach. It is the only way to go, and it's real. So do it.
And my pet peeve is, spend the time to just learn a little bit about your personal finance and take care of it. I mean, everybody spends so much time on their work and selecting the right television set, and the amount you're going to save by saving the right television set versus how much better off you can be by just spending a little bit of time on your personal finances. It changes the course of your life. Just take the effort. And sometimes you just need a place to start, or just to organize it. Well, this is a good place to start getting your mind organized around something.
Yeah, we'd love to hear from you. Email or leave a comment, and stay in touch.
So this one might be one of our shorter episodes, but I think we completed the subject. So thanks for watching.
Until next time, take care.